So what's going to happen here is this is what it is. Now, if they tried to function this the same way, what happens is they just raise the death benefit here. So as this goes up, so does the death benefit. And so they lump this into this so they can give it to you tax-free, right? If they tried to separate them, it'd have to be paid the same way as a regular savings account. That amount that you're accumulating in your cash value would have to be taxed. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I'm going to be touching on a really weird, sensitive topic that people like Dave Ramsey have brought to the front and used as an argument against whole life insurance. And I just want to bring some clarity to it, and that is why, as the whole life policyholder, are you not able to keep both the cash value and the death benefit? It's been talked about in such a negative context, and I think it's so taken out of context because of a lack of understanding. And so for this video, what I want to do is kind of break down, how does cash value accumulate inside of your policy? How does a death benefit get structured inside of your policy? And ultimately, when you borrow against your policy, how do policy loans work? And ultimately, how do all the moving parts inside of the policy function when you pass away, when it comes to the cash value, when you have policy loans out on it, when you don't have policy loans on it, all that stuff. So let's get into this. All right, so what I want to do is I want to go to my whiteboard here and I want to use an example here. So what I'm going to do is I'm going to say, let's say you have life insurance, and let's just say you have 10,000, or let's say you start off year one with zero cash value, and let's say you have actually, you know what? Let me just kind of do this again. I'm going to go cash value, and we're going to go here. We're going to create a T-chart here, and we're going to go death benefit. So year one, we're going to go zero cash value, and we're going to say you have a $500,000 death benefit, right? So if you got a $500,000 death benefit, what happens is you have obviously just the life insurance, right? Like that's really, really clean. It's easy. Now what happens, let's go down the road to year 5. Let's say you have $50,000. I'm going to write 50K for $50,000. What's going to happen is this is going to grow. Now, not all, this is one of the things that I have to make abundantly clear. One of the reasons that Dave Ramsey, Suze, Orman, these folks say that life insurance is a ripoff because the life insurance company keeps the death benefit and your cash values, because these policies are not designed properly when you do it. If you utilize paid up additions functionally the right way, whole life insurance should be able to raise your death benefit along with the cash value. And then therefore what will happen is you have, and this is going to be a ballpark number because it's not exactly dollar for dollar, but the bottom line is your death benefit should grow in the range of $550,000, right? So what's going to happen, because of the function of paid up additions, and if you do the right blend of base and paid up additions, that will grow. So what do you have here? Just now, I'm going to stop growing the policy, and we're just going to focus on these two numbers right here. So then what happens, think about it this way. You have the cash value. The cash value functions as a savings account, right? This is one of the big things that I always tell people. You need an emergency fund. Everybody knows that you need an emergency fund. Dave Ramsey says it, Suze Orman says it. Every financial professional worth their weight in anything is going to tell you that you need to have an emergency fund. So what does that look like? Well, you can put your money in a savings account and you can earn nothing on it, ultimately losing money to inflation every single year. Or you can do what actual banks do and store your capital inside of a whole life insurance policy. Not index universal life, but whole life insurance. Now, think about it. Banks, literal banks, utilize whole life insurance when designed this way to store their tier 1 capital. Tier 1 capital is the FDIC statement, or the organization that manages the risk inside of all banks. Tier 1 capital is basically the foundational reserves, the capital that can be used as capital reserves for banks to leverage money against, right? So for every $10 in tier 1 capital, they can lend $100 against it. It is the stability, the solvency of the bank, right? Now, 25% of tier 1 capital of banks in America right now is held inside of whole life insurance policies. So if it were so bad, why would they be doing it? That's what I mean, like common sense goes a long ways in this instance. So let's look at this and we can realize that whole life insurance is going to beat inflation long term. It's not an investment. So looking at whole life insurance as an investment is a mistake, but it is a great savings alternative. And when we look at what is the point of a savings account, it's to provide liquid access to capital in case of emergency and or opportunity. And so that is the purpose here. So now getting back to the topic here, we have our savings account here is $50,000. Now what would happen? Let's just go back. The options is you could put that money into a savings account. You could go buy life insurance. Let's say if you just want to save and invest, say buy term and invest the difference, right? Actually, so I'll just write that out there. BTID, buy term invest the difference. So what you're going to have is savings account, and then you're going to have the insurance, right? So let's just say you had $500,000 of term insurance, right? So what's going to happen here is you have on the savings account, you're going to start with 0, you're going to save, you're going to get to 50,000, and you're going to still have 500,000 because it's a term insurance policy, right? It's not going to go up. And so what's going to happen if you die, your family gets the $500,000, but whatever you pass to your kids, $50,000, for instance, is going to be taxable, right? And so think about that. So what's going to happen here is this is what it is. Now, if they tried to function this the same way, what happens is they just raise the death benefit here. So as this goes up, so does the death benefit. And so they lump this into this so they can give it to you tax-free, right? If they tried to separate them, it'd have to be paid the same way as a regular savings account. That amount that you're accumulating in your cash value would have to be taxed. And so while Dave likes to talk about this as this massive negative component to a whole life policy, the bottom line is if you design it the proper way, the way it's designed to be, the way that the banks do it for themselves, it is nothing but a value add. It's another way to get tax advantages utilizing the power of whole life insurance. So when we look at this, it really, to me, is extremely clean and clear. The fact that this just kind of becomes a no-brainer, because here's the bottom line. You can also then borrow against this money. Here's the other power to this. So this, if I wanted to take this $50,000 in a savings account, actually, you know what I'm going to do? I'm going to go over here and I'm going to go life insurance, and then I'm going to go buy term invest difference. So now I got that 50,000, right? And then I'm going to say 50,000 cash value, right? What I can do is if I were to take this and spend it, I'm going to spend it on a house. Let's say I put it as a down payment on an investment property. So what am I going to do? I'm going to put that down on an investment property. I'm going to pay cash. And then what do I have? I have the investment property, but then I lose access to cash. That cash is now tied up in the equity in my home, right? So, or in the investment property. So, but over here, I could then take a loan against it. And by the way, over here, this 50,000 is earning 0.1%. This 50,000, let's say it's earning 4.5%, right? So there you go. So I take a loan against it. Now, this is the other thing people wonder. Why would I ever borrow my own money? Why would I pay money to borrow my own money? Well, I'm here to tell you that you're not paying to borrow your own money. You are never borrowing your own money, because if you were borrowing your own money, that wouldn't make any sense. What you're doing is you're utilizing this money to capitalize and guarantee, collateralize, to be able to get guaranteed access to capital through either your life insurance company or a third party bank right now. So what you do is you go to a loan, and what I would do is you could either go through the life insurance company. If you go through the life insurance company, you're going to pay in the realm of 5%, which I could show you how having an amortized loan at 4.5% and a compounding, or an amortized loan at 5% and a compounding account at 4.5%, you're actually going to make out in the long run, earning less than you're paying. And that's because when you amortize a loan, you pay less and less and less interest every single month. And when you compound an account, you earn more and more and more every single month. So what happens is, even though you're earning a smaller percent than you're paying, the amount that you're paying is on a smaller amount every month, and the amount you're earning on the 4.5% in this instance would be getting on a bigger and bigger amount of money, right? So that just ends up adding up. But to keep it simple in this example, what's going to happen is I would never, if I'm talking about wanting to leverage this from a financial efficiency part, I would go to a third-party bank and I would get what's called a cash value line of credit, and I would pay 3% or so on that loan, right? And so that is, I'm telling you right there, that is the power of this cash value line of credit at 3%. Because what's going to happen is now I've got $50,000. I'm leveraging this $50,000 to go take a loan to put as a down payment. Instead of paying cash over here, I'm taking a loan as a down payment on my house on this investment property. But what am I doing? I'm never interrupting the compounding of this $50,000. What I'm doing is I'm paying 3% to access it, but all the while I'm earning 4.5%. So when you look at that, what's the spread? It's 1.5%. So what I'm doing is when I go put my money into my house, rather than giving up the opportunity cost and losing the growth of this, because listen, money going into an investment property, if I have that $50,000 in equity in the property, that's not a good investment, because that property is going to go up or down in value regardless of how I have that capital inside of that. Now, you want to put as much money that you need to avoid PMI insurance, right? But the bottom line is putting cash in there is inefficient. So if we could take it and earn a net 1.5% on this 50,000, because we're paying 3% to get that loan, but that 50,000 is going to grow at this 4.5% rate, and that spread leads to a 1.5% gain. So when you look at the power of whole life insurance and you compare how, when we go to this screen and we look at the fact that, yes, from a perspective of you don't get to keep the cash and the death benefit. They all get lumped into the death benefit. When you design it the proper way, it's actually done in an extremely advantageous way, because the tax benefits in the 550 versus having to pay tax on that 50K, right? It all gets lumped into there. That way it gets passed on in a tax advantaged way, versus when you do the buy term and invested difference, that 50K is taxable and the 500K would be tax-free. So this adds $50,000 of more tax efficiency of assets that get passed on more tax efficiently. And then you look at the fact that while you're alive, the access, the liquidity, use and control this money, the way you can leverage the cash value in your policy is infinitely better, because look at this way. You're earning 0.1% in a savings account right here, right? And I'm going to change colors here. I'll go to blue when I'm talking about this. You're earning 0.1% there. Now you could collateralize this. Don't forget, you could go out and maybe you get a 3% line of credit with a cash value, with a bank line of credit there, because you have this money to guarantee it, right? They're gonna give you that 3%. But in this instance, it's a negative 2.9% arbitrage, so it doesn't make any sense. What makes sense is utilizing a whole life insurance policy to get this 1.5%. So when you just look at the math, it is not that complicated. And the bottom line is the only way to guarantee that this can happen is through the proper design and use of a whole life insurance policy. Now, to Dave Ramsey, to Suze Orman, to all these people's credit, or I guess to their defense, very few people understand how to do this. Very few life insurance agents understand how to design these policies properly. And quite frankly, out of the hundreds of thousands of life insurance agents out there, less than 1% of agents actually know how to do this the right way. And so I guess to their defense, they're just looking after the masses. But just because most people are doing it wrong doesn't mean that the strategy and philosophy is wrong. It's just the fact that agents don't know what they're doing. And the bottom line, once again, just use common sense here. Banks are doing this for themselves. And if it didn't work, why would the bank be selling you all these other financial products, yet be putting 25% of their tier 1 capital into exactly what I'm showing you here for them? And why would you not want to do that for yourself? That's the way I look at it. Is like, common sense is very seldomly common practice, and in this case, that's exactly what we're leading to. So anyway, I hope that makes sense. If you have any questions at all, comment in the comment section below. If you haven't already, make sure you hit that subscribe button, click the bell, that way you get notified every time I launch a new video. As always, till next video, have a blessed, inspirational day. We'll talk soon. See ya.